Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Federico Broquet, Head of US Business at 21 Shares. 21 Shares offers the largest suite of crypto ETPs in the world. In fact, they launched the world's first physically backed crypto ETP in 2018, and that was in the EU. In the US, they offer two spot crypto ETFs, the ARK21 Shares Bitcoin ETF, ticker symbol ARKB, that is in partnership with Cathie Wood's ARK, and the 21 Shares Core Ethereum ETF, the symbol is CETH, CETH. And we are talking about cryptocurrencies and their outlook following the so-called Crypto Week, which was such a monumental moment for the industry. So, Federico, welcome. Great to have you with us today.
Thank you so much, Nina. It's a pleasure to be here with you and your listeners.
So last week, the House passed three key bills: the Genius Act, which is officially law now, the Digital Asset Market Clarity Act, and the Anti-CBDC Surveillance State Act. Could you give us a high-level overview of these bills?
Absolutely. And, it's a pleasure to talk and unpack a little bit of this momentum that we've seen from a regulatory perspective in the US. Last week was certainly a busy week for regulators and for the industry alike. Certainly one of the busiest that I could recall since joining the industry a few years back. But as you mentioned, three big bills that moved forward. I'll start with the Genius Act, which is the one that actually made it into law as of last Friday when the president signed it. The Genius Act is simply looking to regulate the stablecoin market and the issuance of stablecoins in the US. The Clarity Act aims to assign clear regulatory oversight between two different regulatory bodies, the SEC and the CFTC. It also aims to define which cryptocurrencies or crypto assets constitute a commodity versus a security. And the last, bill that we saw some traction on last week, as you mentioned, was the Anti-CBDC Act. And for those who may not know, CBDC stands for Central Bank Digital Currency. And the bill looks to simply prevent or stop the Federal Reserve in the United States from launching its own digital currency or crypto asset, which we have seen happen in other countries like China and Brazil already. The one thing that I'll add here about the resounding support that we saw in Washington across the board is that all three bills received bipartisan support throughout the government, which those of us that have been following politics in the U.S., I know that feels rare these days. But I think it's certainly a sign of the growing consensus among both Republicans and Democrats that crypto really deserves its own regulatory frameworks that's tailored specifically to the industry. And so we're certainly excited about the progress that we've seen.
So as you mentioned, the Genius Act that aims to regulate stablecoins. So it doesn't impact crypto ETFs directly, but I think there are some indirect effects, particularly on Ethereum, because as per my understanding, these stablecoins use Ethereum blockchain. And then you mentioned the Clarity Act, and in my view, that is more important from the crypto industry's perspective, because that provides a framework to classify these assets as either commodities to be regulated by CFTC or securities, which are then to be regulated by the SEC. So we saw a major rally in cryptocurrencies. Bitcoin crossed $120,000 last week, and Ether in particular rebounded sharply. And we also saw significant inflows into these spot Bitcoin and Ether ETFs. Ether ETFs in particular saw record inflows. So could you talk about the impact of these legislative developments on Bitcoin and Ether?
Absolutely. And I'll actually take a quick step back here and just explain why I actually believe the Genius Act also represents a monumental moment for the crypto industry more broadly, along with the Clarity Act, which I absolutely agree with your perspective. The first thing I'll say is stablecoins, for those who may not know, are a representation of dollars on a blockchain. So the best way to think about them is that they're crypto tokens that are designed to always be worth $1. and they're backed by real assets and treasuries or cash for the most part. And so what the Genius Act does is that it institutes guardrails and a framework for how different companies, whether they're banks or not, can issue, create, redeem, and ultimately audit their stable coins in the US. Now, the reason that I think this is very, very impactful for the crypto community more broadly is because ultimately, once you start normalizing dollar-based transactions on blockchains, the next natural step will be to normalize the rest of capital markets. And so you can think down the road, we will begin to see stocks, bonds, and other assets begin to move over blockchain rails once we've normalized using dollars on blockchain. And so to me, this is one of the fundamental investment cases or components of the investment cases for assets like Ethereum, Solana, Sui, the list goes on and on. And so certainly the Genius Act is very exciting. The Clarity Act equally is going to give issuers of ETFs, it's going to give institutional investors, retail investors, and other participants alike a lot of clarity around how different bodies, whether you're the SEC or the CFTC, will treat crypto assets going forward. And there's a big difference between an asset being considered a commodity or being considered a security, and what that means for how ETF issuers, for example, can provide access to clients, but then also how they're treated from a regulatory perspective.
So let's talk a little bit about the broader regulatory landscape. So in general, this is a very crypto-friendly administration. And there are other initiatives as well. For example, the creation of a federal cryptocurrency reserve. So what are the other regulatory developments and potential developments that investors should keep an eye on?
Yeah, that's a great question, and I think we've talked a lot about the Clarity Act, but the truth is it's only passed through this House at this point in time. And so the next step is for it to be reviewed by the Senate, probably will make its way back to the House, and then ultimately up to be ratified to the point where the president would sign that regulation. And so I think from an investment perspective, Clarity Act traction in Washington continues to be one of the top priorities. And one of the things that I think the rest of the crypto community will keep a close eye on. As you mentioned, assets like Solana and Ethereum really have rallied over the last 7 days and beyond because of the traction that we've seen here. And as we get closer to the Clarity Act getting passed, I would expect those assets to continue exhibiting that behavior. Outside of the Clarity Act, the other thing that we're monitoring closely from a 21 shares perspective is what happens with a lot of the ETF approvals in the US. There's over 100 different crypto ETFs under review by the SEC at this moment. And so what we at 21 shares have been advocates for over the last several, I'd call it 18 months, is really to be able to bring to the US market a broad base or a broad amount of diversity in crypto assets in an ETP form. And that's going to facilitate different types of clients being able to diversify their crypto holdings in their portfolio in a seamless, easy, convenient, low cost, and secure way. And so we're coming up to a point of the year where we expect to receive decisions from the SEC around some of these filings. And we're certainly monitoring that very closely because we think it's a great benefit to US clients.
Now, considering recent macro-related developments, including, continued fiscal expansion and the potential for Fed rate cuts later this year, these could be broadly positive for Bitcoin and Ether. So I was interested in your outlook for both Bitcoin and Ether. We have seen that these have lost some of their gains after the rally last week. So do you have, does 21 shares, do you guys have price targets? Or in general, what is your outlook for these?
Yeah, that's a great question. And it's one of the things that I absolutely love talking about the most. If you think from a structural perspective, how the price of Bitcoin, and I'll focus on Bitcoin just for now, is being impacted by this, let's call it institutional adoption and growing regulatory support. Over the last 12 months alone, corporations and ETFs have bought over 750,000 Bitcoins, right? While only 165,000 Bitcoin were minted or newly issued during that same time frame. And so there's this gigantic supply and demand shift, let's call it, that is really bolstering the price of the asset class and is making the investment case, very, very difficult to ignore. Bitcoin this year is up over 20% already, and it's outpacing almost all other major asset classes. If you look at the NASDAQ, that's up less than 10%, S&P around 7%, the Dow 4.5. And so really from a performance perspective, it's become impossible to not have in a well-diversified portfolio. The case is the same for other crypto assets, in my opinion, as well. When you think about the Ethereum, Solanas, and the more growth-oriented assets in the crypto space, rate cuts, as you mentioned, are always strong or always a good tailwind when it comes to risk on assets. And so we think we're at this moment, which is really the golden age of entering crypto markets. And one of the things that I hear the most from investors at this point in time is, did I miss the rally, or is it too late for me to participate? And the honest truth is that we're really in the first inning, if you will, when it comes to crypto adoption. A majority of institutional dollars are still on the sidelines. When I think about different types of buyers, we're still in the very early innings of adoption. And so we think there's a lot of room to run on the Bitcoin side, but certainly a lot of room to run on the altcoin side as some of these assets continue to grow and mature.
So we mentioned institutional adoption a couple of times. Let's talk a little bit more about that. We know that Bitcoin ETFs, spot Bitcoin ETF, they made their debut a little over a year ago, and spot Ethereum ETFs, they just celebrated their first anniversary. And these products have been hugely, hugely popular and have seen massive inflows. So I was interested in who are the main users of these ETFs in the US currently. Are you seeing more interest from individual investors or greater adoption from institutional investors or financial advisors?
It's a great question. And the short answer to that is all of the above. At this point in time, especially since these products launched, we've consistently seen retail investors participate in the crypto ETFs, whether it's Bitcoin or Ethereum. We estimate today that they hold about 50 to 60% of the total industry assets, which sit above the $170 billion mark at this point in time, and it continues to grow. But more interestingly, I think retail will continue to be a participant here. But what we're really seeing come online is these last two groups that you mentioned, which are financial advisors and institutional investors. On the financial advisory side, we're really seeing them begin to adopt Bitcoin in particular through the ETFs because of their end clients asking for these products in their portfolios. And when you're a financial advisor and oftentimes you're fiduciary to your end investors, they go through lengthy due diligence processes and have a lot of success metrics, if you will, before incorporating these products into their portfolios. And so one thing that successfully happened this year, especially in January, was the Bitcoin suite crossed its first year mark, really with zero hiccups from a product perspective, and with these products really performing and delivering the value that they were always intended to pretty seamlessly. And so when you're a financial advisor in the US, that's a really important thing to see before you begin making investment decisions. And so that certainly created this uptick in financial advisor demand. We think that anywhere between 15 to 25% of the assets in Bitcoin ETFs are now held by financial advisors. But what's interesting to note is that when you look at the rest of the ETF industry, outside of crypto ETFs, financial advisors typically make up 2/3, if not more, of ETF holdings. And so this is a space or a client base that is really only getting started in purchasing these ETFs. And we believe will provide long-term tailwinds for the asset class holistically. I'll also touch quickly on institutional investors, which really are, I would say, scattered based on which investor type they really are. I'll start with, hedge funds, who are amongst the most sophisticated institutional investors in the world. They are experts in crypto in many cases, and they use the crypto ETFs primarily for basis trading. And for those who may not know, simply put, all the basis trade is these hedge funds short the futures position and they go long the spot position, and they take advantage of the delta in price between the two. And so they really minimize their risk around the crypto exposure that way. The other, side of institutional investors, which are much earlier on in their investment journey, are really pensions or governmental institutions, which are beginning to dabble their feet in crypto and in the ETF world, but we have not seen yet come into size in a really meaningful way. And we still think we're a ways away with these investors who are typically more cautious, but ultimately we expect them to participate over the long term as well. And so really the US market comes down to those three: retail, financial advisors, and institutions. And we think that we're seeing fantastic tailwinds across the board for each group.
Very interesting. I also wanted to talk a little bit about the role of Bitcoin and other cryptocurrencies in a diversified investment portfolio, because that's a question I sometimes get from our listeners. So tell us, why should investors consider including them, and what allocation weight do you typically recommend to your clients?
When you're building a diversified portfolio, there's a few metrics that you typically look at, but usually professional money managers want to make sure that they're maximizing their risk adjusted returns, right? That's a simple one that they typically focus on. And so I remember when Bitcoin ETFs first launched in January 24, suggested allocations were somewhere in the 1% to 2% range. But what ended up happening is that Bitcoin continued to deliver fantastic performance. And so all these models began, spitting out numbers or allocation numbers that were above that 1% to 2% mark. And so common wisdom then became, you perhaps invest a bit more, you go to 1% to 5%, and you cautiously continue incorporating Bitcoin and crypto more broadly into your portfolio. That has changed and continued to shift since the launch of these products. Rick Edelman, who's one of the most followed and successful financial advisors in the country, he manages billions and billions of dollars on behalf of other clients. He recently came out a few weeks back saying that Bitcoin allocations should be somewhere between 10 to 40% of a portfolio. Now, as a student of capital markets myself, I don't necessarily believe this is appropriate for everyone, given where you might be in your particular investment journey, and everyone's situation is quite unique. But to have one of the most successful and broad-based money managers in the country come out with an endorsement that strongly is just a fantastic sign for where the industry is headed. But anyways, to answer your question, there really isn't a one-size-fits-all. At 21 shares, we typically have clients begin with a 2% to 5% allocation. And as they get more familiar with the space, as they get more comfortable with the volatility that they will undoubtedly see, because it is absolutely a part of crypto that has not gone away and we don't expect to go away in the near term. Once that comfort is built, we really see some clients continue to up and increase their allocation weights. But somewhere in the 1% to 5%, if you're a first timer, usually sits well.
That's helpful. Now, switching gears a little bit, I wanted to talk about risks of a quantum computing attack on cryptocurrencies. And now this is a theoretical, more long-term risk, but it is important for investors to be aware of. So quantum computers have the potential to break the cryptographic algorithms that secure many of the current blockchain networks, including Bitcoin and Ethereum's. And we are still many years, or probably decades away from quantum computers being that powerful enough to pose a practical threat to major cryptocurrencies. But I was just interested in your thoughts on this threat and what the industry is doing to prepare for this threat.
It's a great question. And to be transparent with you and the listeners, I'm most certainly not an expert in quantum computing myself. But what you said, I think, is very consistent from the research that I've seen, which is we're years, if not decades, away from this becoming a practical issue for investors. Now, what I do know for certain is that the cryptographic community in the US is actively developing and let's call it standardizing post-quantum cryptographic algorithms that are meant to be resistant to quantum attacks. And so wallets across the board can be upgraded and have been upgraded in the past to increase their security. And so as quantum computing gets more powerful, our expectation is that cryptography rather will follow suit and will be able to continue keeping up with the increased threats, let's call them, or theoretical threats of quantum computing. What I do know for our ETFs today is that we partner with institutional grade custodians, and they have several layers of security, including regularly rotating keys. They avoid key reuse. And these are two very critical aspects in defending against some theoretical, quote unquote, bad actors that might have access to this super powerful quantum computing. And so needless to say, the industry is certainly focused on this. It is something that everybody is aware of. Whether you're an ETF issuer or you're an employee at one of the largest crypto companies in the world, this is certainly something that's on everyone's radar. And we expect that by the time that those computers come around, security in crypto and the asset class more broadly will be able to keep up.
Excellent. We'll have to leave it there, Federico, but thank you so much for joining us today and for sharing your insights.
My pleasure, Nina. It's great to be here. Thank you so much.
That was Federico Broquet of 21 Shares. Let's quickly recap the ETF tickers. So we talked about the ARK 21 Shares Bitcoin ETF. The ticker symbol is ARKB, ARKB. And the Ethereum ETF is CETH, CETH. And we know that the most popular products in the crypto space are the iShares Bitcoin Trust, the ticker symbol IBIT, IBIT, and the iShares Ethereum Trust, ETF, ticker symbol ETHA. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.